Our next guest says it's time to start paying attention to the deep value names as consumers look to stretch their wallets a little bit further. Joining us now is Anthony Chukumba, Managing Director and Senior Research Analyst covering the retail space at Loop Capital. Anthony, welcome. Good to have you with us. I know you put a high value on the predictive value of consumer confidence measures. Those measures hit a high last month from 2021. That being the case, why are you leaning towards those more value-oriented plays, the discounter plays? Are you seeing some lack of confidence in consumer confidence?
Not at all. I mean, the macroeconomic indicators that we look at are clearly moving in the right direction. They have been for quite some time. Having said that, we are going to have a resumption of student loan payments this fall. So you have at least 40 million loan borrowers who really haven't had to pay their full student loans for over 3.5 years. It's going to be a real shock to the system. We surveyed over 500 of such borrowers, and over half of them said that they were in a worse financial situation now than they were when loan payments were halted. In addition to that, over half of them said that they're going to cut back on durable goods spending to cope with it. So that is the thing that we are a bit concerned with, and we could see a trade down as some of these consumers look to stretch their wallets.
So this looks like a kind of, you're predicting here a kind of retrenching as these individuals, how many of them are there? You said 40 million?
Numbers that I've seen are over 40 million. It could be up to 44 million. It's a big number.
And what is the average amount of payment that they're going to have to pay? It's going to mean they're not going to have that amount of money to put gas in their tank or buy clothing or whatever.
That's right. We've seen different estimates. The number I saw today was about $10 billion. In our surveys, the vast majority of the consumers said that they had been saving somewhere less than $500 a month from not having to make these student loan payments.
So there's the hypothesis. Student loan payments, among other things, will slow some of the spending that we've seen. And that leads you now to some of the choices, the equities that you like. And among them are Dollar Tree, Dollar General, National Vision, and Savers Value Village. I think that's a recent IPO. Walk us through those.
Sure. So, look, Dollar General and Dollar Tree, they are, deep discount retailers. Dollar General and Family Dollar are essentially small supermarkets, very convenient locations, very sharp pricing. Our pricing work shows that they're largely in line with Walmart. So generally in times of economic distress, you do see consumers trade down from the supermarkets, the convenience stores, the drugstores, to a Dollar General, to a Family Dollar, to a Dollar Tree. National Vision is a value optical retailer. Their opening price point in one of their largest chain is 2 pairs of eyeglasses and an eye exam for $79.95. They're already starting to see a trade down happening. And then Savers Value Village is the largest for-profit thrift store in the U.S. and Canada. Their average retail is less than $5. So, these are all 4 retailers that we think could benefit from, a consumer who's looking to save a little bit of money.
Are you looking, you're coming close to suggesting that the economy might go into a little bit of a recession, but you're not really saying that, are you?
No, I'm absolutely not. And quite frankly, the work that we've been doing, a recession, I think, is largely off the table. Those are indications that I'm getting. But I think there is a difference, a middle ground between a recession and a consumer who's still working and maybe making more money, but like I said, suddenly has this incremental payment and is looking for ways, to save money.
It's interesting to hear you say that those student loan debtors say that their financial situation is worse off today than it was at the depth of the pandemic.
Yeah, that was something that really surprised me. I mean, my only guess is that has a lot to do with inflation. Obviously, we've had a lot of inflation. Now, inflation has receded, but you sort of have that cumulative effect. But that was the one thing that did surprise me, particularly given that the fact that unemployment at 3.5% is just a little bit below the 53-year low, or a little above the 53-year low.
All right, Anthony, thank you very much. We appreciate your time and your insights today. Anthony Chukumba, we appreciate it.